All right, we're going to jump right in today because we're breaking down a fascinating argument that a massive financial and geopolitical reset is happening right now, under our noses. And it all kicks off with one absolutely colossal number.
$850 billion. Now, according to the source material we're looking at, this is not just some random figure. This is supposedly the amount of US debt that China is deliberately and very strategically selling off.
Why should you care? Well, because the whole point of this explainer is to connect that huge number directly to your bank account, your mortgage, and yeah, even your retirement portfolio. So let's get into it. First up, Section 1, the $850 billion sell-off. The source we're examining frames this whole thing not just as a financial move, but as something way bigger, what they're calling a geopolitical divorce. So what on earth is a geopolitical divorce? Well, it's the term the source uses to describe the complete breakdown of this economic partnership that the world's two biggest superpowers have had for decades. A relationship that for a long time seemed to work for both sides, but is now, allegedly, being taken apart piece by piece. And this slide really lays out what's changed. For decades, there was this great trade. It was a simple deal. China would send us cheap goods, and the US would pay for it all with IOUs, government bonds. But today, the source claims it's a total 180. China is now reportedly selling off those very same bonds and using the cash to buy tangible hard assets, like physical gold. And this is all part of what the source calls China's grand strategy of de-dollarization. They're apparently dumping US assets faster than at any point since 2015, while at the same time, they've been buying up physical gold for 28 straight months. And the motivation? The source says it's simple. They saw what happened to Russia's assets in 2022 and want to make sure their own money can't be frozen by sanctions. Okay, so how does this actually hit the rest of us? That brings us to Section 2, the bond market seesaw. This is where we get into the mechanics of how a huge sell-off like this could ripple out and affect interest rates for everybody. Now, to get this, you have to understand something called the seesaw effect. It's a fundamental rule in the bond market. Think of an actual seesaw. When one side, the price of a bond, goes down, the other side, its interest rate, has to go up. It's just math. There's no way around it. And this is why that seesaw matters so much. The US government, according to the source, is running a $2 trillion deficit every single year. That means it constantly needs to borrow more money by selling new bonds just to pay the bills. So you can probably see the chain reaction here. The source lays out this domino effect. First, a huge player like China floods the market with old bonds. Suddenly, supply is way bigger than demand. What happens next? Bond prices crash. And because of that seesaw we just talked about, interest rates have to skyrocket to attract any new buyers. And here is the absolute crucial point. This isn't just some abstract drama for Wall Street. The argument is that this process directly forces interest rates higher for all of us, on everything from our credit cards and car loans to our mortgages. Which leads us right into Section 3, the impact on you. Let's dig a little deeper into how these forces could shake up not just your personal investments, but the entire banking system. For 40 years, a bedrock of investing advice has been the 60-40 portfolio, right? 60% stocks for growth, 40% bonds for safety. The bonds were supposed to be your shield when the stock market went crazy. But the source we're analyzing makes a really bold claim. That strategy is dead. It argues that in this new world, bonds are no longer the shield, they are the risk. And this quote from the source just drives that point home. Bonds are no longer the shield, they are the sword. It's a pretty powerful way to describe what they see as a total flip in how financial risk works. And this supposed risk goes way beyond just your personal portfolio. Look at this number, $600 billion. According to the source, that's the current value of unrealized losses sitting on the books of US banks. Basically, the bonds they own are worth way less than what they paid for them. It's a massive hole right on their balance sheets created by those rising interest rates. The source calls this situation the banking system's Achilles heel, and it claims that China's sell-off is like pouring salt in the wound. It pushes rates higher, which makes that hole in the bank's balance sheets even bigger. They even call it a form of asymmetric warfare. And to top it off, they point out that a key emergency cash buffer for the banking system, a $2 trillion facility, has now reportedly been drained to empty. Okay, so if the old system is supposedly broken, what's the alternative? That brings us to our final section, Section 4, a shift to hard assets. This is what the source material presents as the survival strategy. A big piece of the puzzle here is what's known as the petrodollar system. For decades, if you wanted to buy oil on the global market, you pretty much had to use US dollars. This created a massive, constant demand for them. But the source claims that era is ending as major oil-producing countries start accepting other currencies for their oil.
And this table really sums up the two paths the source lays out. On one hand, you have paper assets, like the US dollar, that can be printed into infinity. And on the other, you have hard assets, things like gold, productive land, essential commodities like copper. Things you can actually touch, things that are finite. The argument is that this is where the smart money is heading.
And the whole philosophy behind this move is captured in this one simple line. If you can't touch it, you don't own it. It's really an argument for owning tangible things over paper promises.
So, to wrap it all up, the core argument here is that China is making a huge, calculated $850 billion bet against the US dollar and the bond market that has propped it up. And the question this source leaves you with is a pretty provocative one. Are you, knowingly or not, on the other side of that bet?